Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Welcome to another video on your channel Profit Equities. In this video, we'll be talking about 6 stocks which are expected to report high profit growth this year and hence have the potential to be re-rated purely based on earnings. Now friends, if you have not already become members on Profit Equities, please click on the join button and follow the steps. This will entitle you to member-only privileges like being added to our WhatsApp group and Telegram channel where we discuss profit-making ideas. Also friends, if you are not already subscribed to this channel, please click on the red subscribe button and do so. This will help you get notified whenever we upload a new video. Please watch this video to know more. Now the company in question is Quess Corp Limited, which is available at Rs 613.85 and the face value for it is 10. The symbol for it is QUESS. Now Quess Corp Limited is engaged in the business of temporary staffing services, executive search, recruitment services, housekeeping and facility management services, including engineering services, food services and skill development. Now this is one of India's leading business service providers and has reported strong growth in 2018-19. It is expected to better its growth in 2019-20. Being the leader in general staffing, Quess Corp should benefit from the continuing shift in favor of larger players in the industry. In fact, Quess Corp's growth has been double the industry average. Due to increased contribution from specialized staffing, its margins have also been improving. For instance, its EBITDA margin improved 43% in 2018-19 from 31% in 2017-18. The only negative for the counter right now is that Monster, acquired by Quess Corp in 2018, continues to burn cash. Though Quess Corp expects to break even in the second half of 2019-20, analysts believe that this might happen only in 2020-21. Reasonable valuations is another factor that has attracted analysts to Quess Corp. Given robust growth profile, improving growth quality and cash flow generation of Quess Corp, its current valuation of 24 times its one-year forward earnings is attractive, says a recent Edelweiss report. Now, as is evident from the one-year chart, this company has been a laggard throughout the entire year. The market cap of the company is 8,968.59 crores, which means that this company is a mid-cap one. The EPS of 17.57 translates into a price to earnings ratio of 34.94, which is largely in line with the industry PE of 35.48. The price to book ratio of 3.29 is also not widely expensive. The company has a debt to equity of 0.5507, whereas the return on equity for this company is 0.0990. The company does not pay out any dividends, whereas its promoter holding is a very strong number and stands at 71.43%. Also, none of the promoters' holding is pledged. Now the second stock on the list is the South Indian Bank Limited, which is available at Rs 13.20 and the face value for it is 1. The symbol for it is SOUTHBANK. Now the South Indian Bank Limited provides retail and corporate banking, para-banking activities such as debit card, credit card, third-party product distribution in addition to treasury and foreign exchange businesses. The bank segments include treasury, corporate and wholesale banking, retail banking and other banking operations. Now the market has already factored in the expected turnaround in large banks. However, there are some smaller banks where the growth has yet to be fully priced in. South Indian Bank is one such lender. To reduce NPAs, South Indian Bank is going slow on growing its corporate loan book, so growth from this segment is expected to be low. However, it has been delivering steady loan growth because of increased lending to retail, SME and agri segments. The bank is also expected to report higher profit growth. Though credit costs will remain high due to low provision coverage ratio, fresh slippages are likely to subside. Gradual improvements in the CASA mix and the operational ratios which support earnings, says a recent Motilal Oswal report. The expected recoveries and loan upgrade of around Rs 500 crores will also help South Indian Bank improve its net profit growth. Now looking at the one-year chart, this company has also been an underperformer and no major wealth has been created here. The company is a small cap with a market capitalization of 2,388.78 crores. The EPS of 1.37 translates into a very cheap price to earnings ratio of 9.64 compared to the industry PE of 36.06. The price to book ratio of 0.46 is also very cheap. The company has a decent debt to equity for a bank at 0.9187, whereas the return on equity for this stock is 0.0468. The company also has a very strong dividend yield at 3.03%. Now the next stock on the list is the INDHOTEL Company Limited, which is available at Rs 146.20 and the face value for it is 1. The symbol for it is INDHOTEL. Now, the Indian Hotels Company Limited is a holding company engaged in short-term accommodation activities and restaurants and mobile food service activities. The company is primarily engaged in the business of owning, operating and managing hotels, palaces and resorts. Now, this company, which is the largest player in the Indian hospitality sector, is expected to continue its sharp growth in 2019-20 as well. The 115-year-old company is expected to benefit from the turnaround happening in the hospitality sector. After a few dull years, the hotel industry is now witnessing increased occupancy rates, and this is pushing up the average room rates. The trend is expected to continue for some more years because the demand growth now is much more than the supply growth. This increase in room rates will help hotel companies improve margins and profitability. Since Indian Hotels' occupancy level is placed around 68%, the growth opportunity from the company is quite high. Indian Hotels is well positioned for continued growth due to its sound financials, market leadership with strong brand recognition and asset-light model, says a recent Anand Rathi report. Now, as is evident from the one-year chart, after consolidating for the first few months of the year, the company has been on a slow uptrend. The market cap of the company is 17,386.96 crores, which means that this company is a mid-cap one. The EPS of 2.41 translates into a very expensive price to earnings ratio of 60.66, which is much more expensive when compared with the industry PE of 48.62. The price to book ratio of 3.38 is also slightly on the high side. The company has a debt to equity of 0.6830, whereas the return on equity for this company is also nothing to write home about and stands at 0.0673. The dividend yield is 0.34%, whereas the promoter holding is also a below average figure of 39.09%. Also, none of the promoters holding is pledged. Now, the next stock on the list is Jubilant Life Sciences Limited, which is available at Rs 471.80 and the face value for it is 1. The symbol for it is JUBILANT. Now, Jubilant Life Sciences Limited is an India-based pharmaceutical and life sciences company. The company is engaged in providing basic organic chemicals. The company's segments include pharmaceuticals and life sciences ingredients. Now, this company is one of the two reasonably valued mid-cap pharma companies expected to report good results. Analysts estimate earnings to rise 77% in 2019-20, mostly because 2018-19 earnings were suppressed due to one-off items like high-cost inventory, penalties, etc. As both its divisions, pharmaceutical and life science ingredients, are expected to do well in 2019-20, the expected jump in profit is reasonable. The pharma division's margin should continue to improve because of its presence in formulations and specialty pharma. The pharma segment growth is likely to be healthy due to the recent long-term contracts in the specialty pharma business as well as approval for Rubifil in the US, says an ICICI Direct report. The stock has a price to earnings ratio of 13 and is still trading at reasonable valuations and thus has good upside potential. Now, this company, after consolidating for the majority of the year, has had a huge correction recently. The market cap of the company is 7,514.88 crores, which means that this company is a mid-cap one. The EPS of 36.07 translates into a very cheap price to earnings ratio of 13.08, which is dirt cheap when compared with the industry price to earnings ratio. The price to book ratio of 1.56 is also not widely expensive. Now, one slightly concerning factor is the high debt to equity, which stands at 1.0684. The return on equity is also subdued at 0.1292. The company has a dividend yield of 0.95%, whereas the promoter holding for this company is just about average at 50.68%, whereas none of the promoters holding is pledged. Now, the next stock on the list is HGINFRA Engineering Limited, which is available at Rs 282.95 and the face value for it is 10. The symbol for it is HGINFRA. Now, HGINFRA Engineering Limited is an India-based infrastructure, construction, development and management company. The company is focused on developing road projects including highways, bridges and flyovers. Its main business operations include providing engineering, procurement and construction services on a fixed sum turnkey basis and undertaking civil construction and related infrastructure projects on item rate and lump sum basis. This is primarily in the roads and highways sector. Now, though the infrastructure segment is still going through a tough phase, there are pockets such as road construction that are doing well now. HGINFRA operates in these better performing pockets. This explains its revenue and net profit growth of 44% and 47% respectively during 2018-19, with a strong order inflow of Rs 3,890 crores during 2018-19 and order backlog of Rs 6,220 crores as of March 2019. HGINFRA is expected to report strong growth in 2019-20 as well. Its bid pipeline is strong and HGINFRA stands to benefit from the upcoming orders in the road segment. Speed of execution was a concern and it may improve now due to timely action expected from the new government. The company has not been able to bring down its debt as was expected, and the debt now stands at Rs 380 crores compared to the guidance of Rs 270 crores. However, analysts are not much worried about it because the guidance is expected to be met by September 2019. The expected rate reduction by RBI in its June meeting and the resultant fall in interest rates will also benefit infrastructure players, including HGINFRA. Now, as is evident from the one-year chart, this company was on a slow downtrend for the majority of the year, but of late it has had a huge spike. The market cap of the company is 1844.02 crores, which means that this company is a small cap one. The EPS of 19.54 translates into a price to earnings ratio of 14.48, which is dirt cheap when compared with the industry price to earnings ratio of 23.57. The price to book ratio of 2.78 is also not very expensive. The company has a dividend yield of 0.18%, whereas the promoter holding is a very strong number and stands at 73.74%. None of the promoters' holding is pledged. Also, total debt on the books of the company is 438.8 crores. Now, the final stock on the list is Disman Carbogen Amicis Limited, which is available at Rs 239.35 and the face value for it is 2. The symbol for it is DCAL. Now, Disman Carbogen Amicis is an India-based contract research and manufacturing services company. The company is engaged in the process of research and development to late-stage clinical and commercial manufacturing. It operates through two segments, which are CRAMS and others. Now, as is evident from the one-year chart, this company has been on a consistent downtrend for the majority of the year. However, of late it has had a spike. The company reported 36% earnings growth in 2018-19 and analysts believe its strong earnings growth will continue in 2019-20. All key segments have contributed to Disman's growth. All its subsidiaries also reported profits in the fourth quarter of 2018-19. Since Disman is the only listed company that manufactures complex commercial active pharma ingredients for innovators, it is a proxy for long-term structural growth story of value-added pharma. Ideally, Disman should be quoting at par with similar Indian companies, but it's trading at a deep discount to its peers, which might narrow going forward. This is because, unlike generics, the API segment business is more sustainable and is also insulated from pricing pressure until patent expiry. In addition to its growing commercial pipeline, Disman also has a strong base of preclinical phase 1 molecules which are more than 250. With a net debt to equity of 0.16, the company also boasts of a very strong balance sheet. Now, the market cap of the company is 3,862.97 crores, which means that this company is also a small cap one. The EPS of 13.06 translates into a price to earnings ratio of 18.33, which is much cheaper when compared with the industry price to earnings ratio of 28. The price to book ratio of 0.72 is also very cheap. The company's debt to equity is 0.1641, whereas the return on equity for this company is 0.0402. The dividend yield is 0.08%, whereas the promoter holding is a good number and stands at 61.40%. Now friends, please don't consider this to be a recommendation on our part. Please go ahead and do your own research. This and all the content that you see on our channel is intended to be a piece of news. We will be providing the link to the source for this video in the description section. Please go through it to build more conviction around your investment decision. Thanks for watching, and if you have not already subscribed to this channel, please consider doing so.